Hey everybody, I'm Brogan McGuire with Caliber Home Loans, and today David is out of town, so we have
MJ, Valley Premier Team at my home group. Thanks for having me.
And today we are going to be talking about just a few things that we really wish people understood a little bit more about the current housing market, especially if you're a first-time buyer or a little bit more of a cautious move-up buyer. So with that, MJ, you obviously deal with a lot of buyers. Being a realtor, I'm now teeing you up for the question that you were supposed to tee me up for.
Yeah, so, I know. You just carried on.
Yeah, just kind of we just kind of bullshit our way through this.
Okay.
Yeah.
So just some questions that my clients have been frequently saying. Well, not questions, but some comments that have been made to me lately have been that my clients are waiting for the market to crash and foreclosures to happen.
Right.
Now, seeing that you are on the lending side, what are your thoughts on that?
Well, there's a couple things that I want people to understand about, because everybody has a lot of PTSD from 08 and 09. It's a very different show today than it was back then. Lending practices are wildly different. The market is wildly different. There's really nothing that is equivalent today as to it was in 08 and 09, other than the fact that prices are increasing. And I think that's the trigger for a lot of people is, how prices are going up overnight, 30% in Phoenix in the last 24 months, and that's kind of harking back to, 04, 05, 06, as things were just kind of skyrocketing before the crash. But again, it's a different type of acceleration now.
Okay, so with you saying that, how are the loans different from 08, 09 compared to now?
Well, the main thing is the mortgage industry as a whole got completely overhauled because of 08. The mortgage industry was really the main culprit of what occurred back then. And the main reason for that is there was very little regulation on the mortgage industry. There was people getting loans on homes in their dog's name. I mean, stated income, they had what was known as ninja loans back then. No income, no job, approved. I mean, anybody with a pulse, and sometimes actually people without a pulse, could get a mortgage back in 06, 07. So it created this frenzy as prices started to increase. Everybody jumped on the bandwagon, and it created this bubble of artificial demand because people were buying homes they couldn't really afford. And the main catalyst that really kind of started the crash was everybody was doing these adjustable rate mortgages. Because interest rates back then were nowhere near as good as they are today.
Right.
Interest rates in 04, 05, you're looking in the 5s and 6% ranges sometimes. So what people would do is they would do an adjustable where you have a teaser rate for 1 year or 2 years, 3 years, up to 5, 7 years, depending on the structure of it. And they would have, say, 3% for a year, which 3 to 6% on your mortgage payment is a massive difference in payment. And I can provide some examples for that here in a minute. But essentially, the way it ended up working out was all of those adjustable rate mortgages had their teaser rate end around the same time. So within a 6-month span, people's mortgage payments, almost doubled overnight. And as that was happening, there was, the economy because of that was declining. Obviously, a lot of people lost their jobs, and because of that, all of a sudden your income goes from here to here, and your mortgage payment goes from here to here. It was a recipe for disaster. It really was. I mean, it's honestly, it's amazing that it wasn't even worse than it was, because it really was a catastrophic event. We're really worse than the Great Depression. It really was. It was our generation's Great Depression,
right? The
Great Recession.
It's true.
So, so something to think about with that, as I mentioned, mortgage rates. Let's take it back to 2019. Again, mortgage industry was totally reformed after 08, 09. We have TRID, RESPA, many regulations, many rules we have to follow. But again, going back to those mortgage rates of 2019, you were about 4.5% was the average interest rate that year. And according to Zillow, the median housing price in 2019 was about $275,000. Well, a $275,000 loan on a 30-year mortgage at 4.5% gives you a monthly payment of $1,393 a month, principal and interest. Today, the median housing price across the United States, according to Zillow, is about $345,000. Now, the average interest rate today is about 2.75%, 2.85%. That gives you a mortgage payment of $1,408 a month. So virtually the same payment, but the big thing that I want people to understand here is at 4.5% on the less expensive home, you're going to spend an extra $65,000 in interest over the life of that loan between those two scenarios. 1 or 2% doesn't sound like very much.
It's huge.
But on a 30-year term, it's massive. It's truly massive. So just because homes are more expensive today doesn't mean they're less affordable. In fact, in some cases, they could be just as affordable, if not slightly more, than they were a few years ago. So essentially, MJ, at the end of the day, now is still an amazing time to buy, especially in a market like Phoenix, where we've got a lot of upward mobility. We've had more people move into Maricopa County than any other county in the country for, I believe, 9 years running now. It's a phenomenal place to buy. There's certain markets in and around the United States that may see things slow down quicker than others, but in the state of Arizona, things are going to continue to grow for the foreseeable future, and it's a great time to be buying a house.
Well, that's awesome to hear. I know it's great to buy. Another question that I've had is about foreclosures. What are your thoughts on that?
Well, and again, this harkens back to the PTSD of 2008, but the big thing that comes up in that
I guess it's not a question, it's more of, we're going to wait for the foreclosures to hit the market so we can buy those at a lower price.
Right. People think that there's going to be this flood of foreclosures because of all the homes in forbearance. Well, bear this in mind, a lot of people took advantage of forbearance because it was available. Like stimulus checks. Not everybody that got a stimulus check necessarily needed a stimulus check, and I don't mean that to be in a political way, but there was a lot of people that were able to hold through COVID, and the stimulus check helped out. But if the government's offering you free money, why not take it?
Exactly. Yep.
Or if you can defer your mortgage payment for 2 years and sock away some extra money, why not? And to those people's credit, in the beginning of COVID, we really had no idea how this was going to play out. I mean, it was so up in the air. Nobody really knew anything. I mean, I wouldn't have expected us to be in the position we are today. I mean, I was one of the people who I thought it was going to be pretty catastrophic as far as the economic toll, and obviously that's not what ended up happening. 6 to 12 months later, but because of that, there's a total of about 1.5 million homes in forbearance in the United States right now. That being said, there's no exact number on how many of those people truly needed the forbearance. There's some estimates out there, but those estimates are between 50 and 60%. So let's call it 50%. So 750,000 homes in forbearance of people who truly cannot afford to make their mortgage payment.
Now, is that in Arizona or throughout the United States?
That's nationwide.
Wow.
That's nationwide. Yeah. So with 750,000 homes in forbearance around the country right now that are truly can't afford their mortgage payments, what has happened is Fannie Mae and Freddie Mac actually came out with a new refi program that allows people who have kind of pushed past their traditional debt to income limits of about 40 to 50% up to 65%. And that allows people who are in a hardship situation to refinance and get to a much lower rate, potentially cancel their mortgage insurance, save money on their payment every month, and hopefully that allows them to keep be able to stay in their home. But even if they don't qualify for that, everybody has equity in their home right now. The average person has about 35% equity in their home.
Wow, that's good.
Yeah, it's phenomenal because we've seen such huge gains over the last 2 years. So even if you're in a position where you truly can't afford to make the payments, if you bought even 6 months ago, you could easily sell your home and actually walk away with some money, even after paying closing costs and things like that. So there's very, 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 very few people who truly cannot get out of their home and will need to foreclose or short sale. It's just not the same market that it was in 08, where people bought for 500 or 600 and put up nothing down, and then when the bubble popped, they owed 500 or 600 and it was now worth 250. It's just not the same situation as we had back then. Then I hope that helps your buyers understand things a little bit differently. I hope that helps you understand things a little bit differently. And obviously there are a few estimated numbers, in these equations, but there's really no true way to know for sure. But if you have questions about your specific situation, about how any of this might apply to you, feel free to give me a call, give MJ a call. We're happy to help in any way that we can and just be a resource for you guys.
Well, thank you, Brogan, for clearing that up. Very helpful information. A lot of questions that I've had from my clients have been answered today, so I really appreciate the time you've taken. I think that's all we have for you guys today. Thank you guys for watching.
Have a good one.